Hello everyone, I'm PK. I'm the founder and the lead developer of TradeSwiss.com. TradeSwiss is an advanced trading journal and a tool that can help you trade better. So in this presentation, we're going to see how TradeSwiss can help you improve and understand your trading psychology. So here's what we're going to cover today. First, we're going to define trading psychology in general, and then we're going to go into what is qualitative and quantitative analysis, how it is related to trade journaling, and how you can use TradeSwiss as a trading journal to solve all of these problems, and what is a systematic approach to improving a psychology using TradeSwiss, and what are its benefits. So let's define trading psychology, right? In a nutshell, it's just your emotional mental state when you're trading, right? Whether you are curious, whether you are, let's say, anxious, whether you are really finicky, whether you are, fickle-minded, whether you change your attention span really quickly, whether if you had a bad day, how does that reflect on your trading? A lot of things like that, right? So a lot of things can influence the way that you trade. It's not just your strategy. It's not just the way you execute your trades. A lot of things go on in your mind when you're trading, right? So one of the two most primal feelings that we have is fear and greed, right? So that greatly influences how a lot of us trade. So we have things like fear greed index for indices and stocks and so on. Another very common, I would say, a factor is fear of missing out, right? Hey, there's this new penny stock. It might go 10x or 100x, or there's a new crypto coin. It might go 100x or 1000x in the next couple of days or couple of weeks. That's fear of missing out, right? So these feelings combined together make your trading decisions good or bad, right? And the way that we improve trading psychology is to make sure that these feelings or these primal instincts do not interfere with your decision making process when you're trading, right? And when I say do not interfere, I mean do not interfere in a negative way, right? And this is really hard to define unless you've experienced this yourself, right? And another way that all of this kind of ties together is how you feel about your losses and wins, right? You might feel that hey, I got $100 today. That's a good day. And when you lose a $50 and when you lose $100, you might feel really sad, right? So those sort of psychological behaviors are also part of the trading psychology, right? And these things you only get used to, and your trading psychology improves when you have a lot of experience trading, when you have a lot of experience going through these ups and downs, right? That's when your risk taking capability increases, and that's when your money making mentality disappears, and you have a more systematic approach to things, right? You have a consistent state of mind, you have a calm, peaceful state of mind, you know what's happening, you know what's going to happen, you know how to handle situations, and so on, right? So this is in a nutshell what trading psychology is, how it affects you, what are the different states, and how it affects your trading in general. So we have a lot of talk around psychology in social network, and a lot of things like we've heard a lot of things like let your winners run, or cut your losers fast, or a lot of these platitudes, if I may call it, are not really useful to any traders. They might sound good when you hear them, or when you read about them in a tweet, or in a Facebook post, or in a fancy Instagram photo or something. But I've talked to thousands of traders as part of my development throughout TradeSwiss, and I've never had a discussion where any of this has helped a trader, right? And this is just one data point for myself. You can ask yourself this: has this helped you, right? A lot of these advice that you see online from trading gurus, trading gurus, whatever you want to call it, they're just they're not applicable in most scenarios, and they are very vague and random, right? So especially trading psychology itself is a field that's hard to crack and that's hard to understand, right? And in this field or in this sector of trading, you need something that's solid, that's that's rooted in facts, that's rooted, that's objective, in order for you to establish a way to measure and improve it, right? And every trader is different, right? And trading psychology is something that varies so much among people, right? You might be There might be a case where you are a natural born risk taker or something like that, right? You might be exposed to taking risks all your life, and that kind of carries on into your trading. You might be a very frugal person, someone who grew up in a poor neighborhood, someone who grew up in a not so financially well family, but you are in a good position right now, so you are very careful about how you handle money, right? So your past definitely affects your psychology. No two-person, I would say, would be the same set of would have the same set of psychological traits, right? So one of the worst possible things that you could do is just take a random generic advice from some random person on online and apply it to your trading, right? And in this presentation, we're not going to focus on specific pieces of advice like do this, do that, follow price action, take this indicator, don't use this indicator, or don't trade this stock, or don't trade this asset type. We're not going to do any of that, right? The reason is this: you can be trading any stock, you can be trading any asset type, for that sake. You can be trading any quantity of it, you can be trading any amount of money in it, right? So what we focus on here is to make sure that you can get insights that are tailored exactly to the trading history that you have, right? So your trading history, right, whether you have 100 trades or 1,000 trades or whatever, is pretty much a reflection of your trading psychology itself, because during every single trade you have to make decisions, and those decisions are affected by your trading psychology, right? So those trades, that trading data alone pretty much has your psychology built into it, right? And our job, a lot of features that we have in TradeSwiss is to extract that in such a way that you can utilize the insights from it and use it to improve your psychology. And how do you measure psychology, right? We keep saying psychology. How do you measure it, right? It's not like it's not like your win rate, or it's not like your profit factor. It's not like your hit ratio, your total P&L per month, or returns, or something like that. That's quantitative, right? All of those numbers are quantitative, meaning you can give exact numbers to them, right? How much have you lost in the last month? How often do you trade per day, right? So the examples include how much P&L did you get trading large cap stocks, right? How much P&L did you get trading 0 DTE SPY puts or whatever, right? These are quantitative pieces of information, right? This data is easy to get, right? And qualitative is something that is expressed, that's something that cannot be expressed mathematically, right? So it tries to explain the how behind the numbers, or the why behind the numbers, right? An example is, why didn't you cut your losses sooner, right? And why didn't you take that trade, right? And why did you add to your losing position? So questions like this are qualitative, right? And obviously you would argue that a majority of trading psychology is qualitative, right? So why did you have this sudden urge to buy the stock when it's going up really high, right? You should not have bought that, right? So why did that happen? You can't put a number on it, right? It's not like my greed level was 6, or my risk level was 10, or something like that, right? So this is the difference between qualitative and quantitative, and this is going to be most of what we're going to be talking today. And the reason is that we can actually convert one from the other, right? And this has not really been explored a lot, but that's what we try to do at TradeSwiss. That's one of the things that we try to do at TradeSwiss, right? So how do you improve your how do you make improvements? How do you measure something that you are trying to improve, right? That's not really possible to do if it's qualitative, right? And what we have to do is convert that, or try to convert the qualitative factors into quantitative factors, so that you can find a way to properly improve it, find a way to properly measure it, and find a way to get a balance between the qualitative and quantitative factors, or convert it back so that you get the the pros and the cons, especially the pros of the improvements, right? So while qualitative analysis can be hard in trading, we can convert some aspects of your performance into quantitative data for effective measurement, right? If you can't measure something, you can't improve it, right? And trading psychology is not a exception to this fact at all, right? You might be thinking, I need to calm myself, I need to engage in meditation, yoga, whatever, decrease your stress in everyday life. All that is good, but none of that you can measure it quantitatively, right? You can't measure your psychological levels on every single day. You can give a score, but on what basis is that score based on of, right? So you have to strike a balance between what you're transferring, what you're converting, how you are improving, and so on, right? And you need a platform to do all of this in the first place, right? There isn't one at the moment except for TradeSwiss, and that's the reason that we are focusing on TradeSwiss, and that's the reason why TradeSwiss is the number one preferred trading journal for every single trader in the past 2 years. And the reason is that you have not only the basic stats such as the P&L, profit loss ratio, whatever, win rate, and whatever. We give you a lot of insights on how you can use this to improve your trading, and we are going to look at exactly those insights in this presentation. So how can a trading journal even help? Like, how can TradeSwiss even help here, right? And you have, so number one, a trading journal is basically a repository of a large amount of data that you generate when you're trading, right? And this includes your entries, your exits, what did you trade, what market did you trade in, what are your stop losses, what are your profit targets, and a lot of things like that, right? And another huge advantage in trading journal is that if your journal is good enough, like TradeSwiss, there is absolutely no need for you to write down every single trade, right? TradeSwiss can automatically sync your trades from your brokers, and that's something that that's another thing off your head, right? So we take care of that for you. So everything is there in one place, and all that is left for you is to analyze from it, right? To get insights from it, right? So while a trading journal only gives you quantitative analysis, right? Trading journal has a lot of data, and from all of this data, it's pretty much all numbers and statistics, right? So you might be wondering, why is the psychological part of it? So we are getting to that part soon. Our argument, or our goal with this presentation is that we are presenting, or we are proposing that a lot of these quantitative factors can indeed be converted to qualitative factors, right? So you can go both sides, right? And we're going to explore both sides also in this presentation, right? So another huge advantage of trading journal is that the data that goes into trading journal is traded agonistic, right? You might be thinking of psychology in a way that's completely different from the person that's next to you, right? But if you look at the trading journal of both the traders, you're going to have very similar numbers in terms of things like win rate, profit loss ratio, hit ratio, R ratio, returns per month, returns per day, win percentage, loss percentage, and things like that, right? That is going to be similar. However, the trading psychology, or the qualitative factors of those two traders are going to differ a lot, right? So the answer is combining and effectively using data, right? And nobody does this as well as TradeSwiss. We'll get to that in the further parts of the presentation. And what we do is we pretty much try to use as much data as possible to give you the best insights. It sounds really simple, and you might think of this like, why didn't anybody do this? Like, why wasn't this why isn't this common, right? And the reason is that nobody has been able to pull this off in a way that's as effective as what's presented in TradeSwiss, right? And the way that we combine data, and the way that we analyze data, and the way that we present data is something that's unprecedented. And so that's the reason why you not only get quantitative analysis, you also get qualitative analysis and a lot of insights into how you can improve your trading with TradeSwiss, right? And this is not just a huge plug for TradeSwiss or anything like that, but this is genuinely a way that you can use to convert or to look into your trading psychology using just numbers, right? That's the main goal of this presentation, is to look at how you can convert the numbers that you see, convert the charts, and convert the ratios and everything that you see on the TradeSwiss Trading Journal into psychological factors, psychological analysis, and so on. Right? If you have an Excel sheet, if you are using another trading journal that has the same information, right, you can apply the same principles. Right? You can do that. All of this is platform agnostic, trader agnostic, and trading style agnostic, right? And that's the biggest advantage of what we're trying to achieve here. It's that you can convert one data to another. You can do psychological analysis. You can do trading psychology improvement using just looking at your trading numbers. And that way of analysis is what we're going to explore in this presentation, right? So let's finally look at psychology analysis using TradeSwiss. We are going to be switching tabs to TradeSwiss sample account to see how each of these techniques can be used, right? So what we are going to be doing is we're going to be looking at quantitative analysis and how this can be, for example, correlated to psychology, how this can be correlated to your trading behavior, how this can be correlated to something that's qualitative, right? So the first two things that we're going to be looking at is the best ranges and best timing, right? So best ranges, like, how do you define ranges? What are ranges? Trading has a lot of numbers, right? And if you have a lot of numbers, you're bound to have a lot of ranges, right? Minimum, maximum, average, median, and so on, right? You have, for example, price ranges, volume ranges. You have indicator ranges, ATR ranges, ADX ranges. You have things like market cap ranges, and a lot of ranges are there, right? And so what we are trying to do here is we are trying to look at how these ranges can be used effectively as a way to improve your psychology. For example, this is the dashboard of TradeSwiss, and this is what you're going to see when you log into it. So the ranges that we're going to be looking at, for example, are just the price versus P&L range, right? So again, you might be thinking, hey, this is just quantitative analysis, just looking at numbers of P&L that you've earned per price range. But bear with me. So what we are looking at here is, on the first look at this, you might be saying that, okay, this trader is bad at trading penny stocks. This trader is also bad at trading large cap stocks or stocks above price of 200. Right? So is that really the truth, though? Is that the level of insight that you get from this? Or if that is the level of insight that you get from this, then you are pretty much stopping at a very simplistic quantitative analysis, right? What you need to look further is, how does this compare to, let's say, the amount of volume that you've traded, right? And how does this compare to how much money you've made and how much win rate you have, right? And let's again go back to this chart, right? Let's say that, okay, hey, I'm bad at trading $200+ ranges. Let's explore this. So what do we see here? We see two trades deeply in the red and one trade slightly in the green. Right? So does this mean that I'm bad at trading this particular range? Does this mean that I'm not capable of handling stocks that are expensive? Does this mean that when I have, say, for example, $300 worth of, $30,000 worth of shares, I'm not good at trading it? Why don't we explore that too? Let's go into this particular Microsoft trade where we bought and sold 100 shares of it, right? And the price is $283. So that's going to be a total of close to $30,000, the total price. You can see here the total position cost is $28,000. Right? So what happened here, right? And we entered over here and we exited over here. Would you say that this is a bad trade? This is really a bad entry, but this is not a bad exit. Right? This is literally the best exit that you could have had, and TradeView shows that. Right? So, are you going to assume that this person is not good at trading large caps, or are you going to assume that this person is simply not good at finding the right entries? Right? We are already in the psychological range. We are already in the qualitative analysis of this particular part. Right? So you can get the idea over here that it's not just a simple fact of looking at the first layer of data. Right? What you need to look at is combine the data together and then fine tune what exactly you need to look at. For example, let's say that, hey, I have 5 wins here and I've earned close to $900. Right? So I'm just going to keep trading $5 to $10 stocks. Is that a good idea? Let's see. So far so good, right? So far you can see that most of the P&L, I mean all of it is nicely in the green. So we do have 2 outliers over here, right? And let's take a step back and look at another factor called duration of the trade, right? So we have 3 trades where the duration is more than 1 day, meaning it's a swing trade, and we have 2 trades where the duration is very short, right? So does this mean that this trader is only good at trading longer duration, shorter, smaller price range stocks? Quite possibly true, right? So this could be a nice here it says Iron Condor, so it's an Iron Condor SPX trade. GSPC is SPX, by the way. So this could be another analysis that you might want to implement or just keep in mind. For example, hey, I'm good at swing trades. I'm good at swing trades where the cost is between 10 and $20, right? So this itself gives you a lot of insight into what is good for you, what is bad for you, what you're good at, how you are managing your trades. Right? For example, you are good at managing your trades when the duration is longer. Right? We are not so good at managing trades when the duration is shorter. You might be leaving a lot of money on the table. Right? So that's one particular example. Again, you can look at the time and duration over here. The duration is right over here. So here you can see again. I mean, we just kind of explored this part, right? We almost derived using just a few trades and few in-depth analysis that we are actually good at trading stocks by holding it longer than a day. Right? You look at all of these stocks over here, all of the trading statistics over here. The amount that we've made is just almost break even here. Right? So minus 200 plus 200 plus 400, and that's it. Right? When you get across the 1 day barrier, that's where you see a lot of profit. That's where you see $1,000 of profit, $700 of profit. Right. So what we've learned here is that it might be good to look at the trading ranges that are over 1 day. The holding period is over 1 day, right? So that's something that here, for example, looking at this another way, if you take the overall ranges such that it maximizes your win rate, that would be between 12 and 28 days, where your win rate is 72%, and this results in a profit of $1,700, right? So as you can see, we just went from quantitative to qualitative, back to quantitative, and back to qualitative, right? So this sort of an insight is what you need, right? All you need to do is just spend a couple of minutes per day doing this. This itself is going to give you a huge edge in terms of what you need to do and how you can improve your psychology and what part of psychology you need to improve, right? And of course, you also explain the best timing. So again, this comes as part of the duration, right? This comes as part of when you should take a trade, how long you should take a trade. Maybe you shouldn't take a trade on Fridays. Maybe I shouldn't take a trade on Wednesdays. Why shouldn't I take a trade on Fridays? Am I scared that okay, it's the weekend, right? Anything can happen, and I'm scared of holding the stock throughout through the 2 days and coming in for a big surprise on Monday. Do I want to do that? Maybe not. Maybe not, right? And the stats clearly show this, right? I do have a greater than 50% win rate on Friday, but look at the P&L. So what does this say? The trading that happens on Friday is not really successful trading, right? So there are multiple ways that you can look at this, right? I'm going to select both wins and losses of this particular day so that we can explore the full picture here. So if you look at the P&L over here, it's slightly above break even, right? It's just almost at break even, pretty much break even actually, right? And all of these trades, I would say, let's sort by duration. They are all within very short period of time, right? So except for this one particular trade, they are all within one very short duration of time. So again, what does this say? We are not really good at holding stocks for a very short period of time. We are comfortable with letting the stock do whatever we want. We are not good at trading on Fridays. Why? Because of our anxiety, and since we are holding stocks for a very short period of time and not letting it, let's say, a little bit of room for it to go up, down, and then come back to our expectations. What's really happening here is that we are losing out on a lot of profits, right? So this is a complex iron condor. So anything could have happened over the weekend. So maybe it's not a good idea to trade iron condors on Friday, right? Because it doesn't really fit with our psychology. It doesn't fit with our current mentality. So again, another example is what are the best market conditions, right? And a prime example of that is looking at the market indicators in TradeSwiss, right? And how should we convert this into a qualitative analysis, right? And so let's look at one particular example here. Let's look at the P&L versus ATR of SPY. That ATR is the average trading range, and if the average trading range is really high, what happens is that basically SPY's movements becomes really unpredictable, and you're going to have huge swings. You're going to have huge uptrends, huge downtrends, right? And it says that we are really good at trading this particular range, right? And we can explore a little bit further by changing the indicator range, and now we have a little bit of a better idea, right? So it's not exactly that we are good at trading a larger amount of ATR. It's just that we are good at trading different ranges of ATR of SPY, right? Another example is, for example, let's take gold, let's take CCI, or let's switch back to SPY. And here you can see that it's up, down, up, down, up, down, right? And can you kind of guess why it's like that? Let's simplify it further. Look at this. It's a mess, right? But is it really a mess? Think about what we are plotting it against. We are plotting it against CCI of SPY. CCI is commodity channel index. Here's the Investopedia article, and look at how the indicator kind of moves. This is not an oscillator, by the way. An oscillator is something that has a bounded range, but CCI can oscillate, meaning it can go up, down, up, down. We have, overbought range, oversold range, and things like that, right? So same thing applies to CCI, but without an upper bound or a lower bound, right? So that's pretty much how it works. So what does it say over here, right? So it says that we are either good at trading the upper ranges, or we are either good at trading, or we suck at trading the upper ranges, right? And that is something that you might need to explore further. Like for example, let's look at this particular trade, particular chart over statistic over here, which says that between the CCI of minus 150 to 100, we've earned a little bit of money, around $600 to $700. So what does it say? It says that we are doing well with swings of CCI rather than constant constant action or constant behavior of CCI. And this also pretty much goes in line with what we saw with ATR, right? So what it says here is that we don't really have a lot of let's say profit in the lower ranges, but we are starting to have a lot of profit in the upper ranges, more active ranges of SPY, right? So this is one example of how markets can affect your trading, and markets can also affect your trading in multiple ways. For example, if you are not good at let's say sudden changes in SPY, right? Are you good at trading sudden changes in SPY? Apparently, looking at the stats, we are. So this says that we are capable of handling varying market conditions. That's as evident by looking at the CCI chart, as evident by looking at the ATR charts, as evident by looking at the 14-day price change charts. Right? So we are okay with the market being volatile. Right? What that says is we are okay with doing risk management even when there's a lot of confusion in the market. Right? Now, if you were to see these ranges completely, just segregate in one particular range, that condition wouldn't apply. It means that we would be bad at trading ranges. We would be bad at trading volatility. So this particular trader thrives in volatility. That's what I can say. That's what the statistics shows. That's what the qualitative analysis also show, right? And what is the best thing to trade, right? So there are so many stocks to trade. So again, psychology here plays in the following way, right? So we have a lot of traders who say that, hey, I'm only going to trade AMD. I'm only going to trade SPY. Right? We have a lot of traders who say that. You might even be one of those traders. You might know one of those traders, and that could be a good thing. That could be a bad thing. Right? How do you know that? Right? So for example, here's a tree map of all the symbols, not all the symbols, just a couple of 20, 30 symbols that this particular trading account has. Right? So a lot of profit has come from GM, right? A lot of options are there, and AMD not so good, Microsoft not so good, Peloton not so good. So are we converging to a theme over here? Let's check the sectors. And we were right. Technology sector, a lot of reds over here. So we're not really doing so good in the technology sector, right? If you're not a fan of these charts, you can simply go back to the bar charts, which is again technology sector really bad. I mean, comparatively, $200 is still a smaller amount, but compared to what we've earned, it's not so good, right? So maybe not. We shouldn't be looking at just one particular stock. Maybe we should be looking at different sectors, right? So this is something that you might need to look at, right? So this is a mentality that a lot of people have, that hey, I had a really good couple of months of trading SPY, so I'm just going to trade SPY for the rest of my life because SPY is the thing to trade, right? No, that's not going to work, right? So of course we have a lot of futures traders who trade only ES or only NQ or something like that, but you might not want to restrict yourself to such a narrow position, right? So that's what this analysis is trying to tell you. So what are the best strategies and what are the best targets? Right? In best strategies, it's very easy to analyze how you simply tag your trades. It's as simple as that. For every trade that you take, I'm pretty sure that you have a particular reason for taking that trade, right? It could be strategy one, it could be strategy two, it could be gap up, it could be whatever, right? It could be choppy trade, it could be a market open trade, it could be an options trade, it could be anything, right? And you just need to tag it. If you are using something like Thinkorswim, or if you're using TradeSwiss, we do the tagging for you. If you trade options spread trading, so this is a vertical bull put, this is an automatically added tag. So this again gives you an idea of what you're good at, what you're bad at, in a very, very simplistic way. I mean, so of all the things that we looked at so far, this has the closest connection or the shortest connection of conversion between qualitative and quantitative, right? So pretty much whatever you're writing over here is indeed qualitative, right? You are essentially saying to the system that, okay, this trade is something that I did because of this. That itself is qualitative information, right? And you have stats based on that. This is intermingling or rather combining both qualitative and quantitative analysis, right? It's very simple, right? You just tag your trades and you have a lot of analysis you can do based on that alone, right? So moving on, you have best targets. So the way you want to look at this is, should I hold on to a trade for longer periods of time, or should I hold on to a trade for shorter periods of time, right? And we're going to simplify this by using just stocks so that it's easier to understand. So this is MFE and MA analysis. MFE stands for maximum favorable excursion. So what that means is how much the price of the underlying that you're trading has gone in favor of your position. So if you're long, how much the price has gone up, and if you're short, how much the price has gone down, right? And MAE is the opposite of it. It's maximum adverse excursion, right? How much has the price gone against your position? If you're long, how much has the price gone down? If you're short, how much has the price gone up, right? And we can look here that, of course, we have a reasonable amount of trades over here. We are looking at the price percentage MFMAE, which says that how much has the price moved up or down with respect to the open price of the trade, right? The open price of the trade. And so we are seeing that there are a lot of trades clustered in this small region, which says that we have a bunch of profit where the price has only gone up or only gone in our position for around 5%, right? And the same for MFE, but it's a little spread out over here, right? And what that means is it could mean that we are taking our winners very shortly and we are letting our losers run a little bit, right? Or we're taking a lot of risk over here. For example, look at this particular trade. The price has gone against us 15% and somehow we ended up in profit. But is that a good an indicator of your risk management? It's not. So here you can just think about it. We just went from quantitative to qualitative. We just went from MFE to your risk management skills, right? And this is how you want to manage these things. For example, look at this bail and K trade, right? We've gotten a profit of 320, which is really good, and the price percentage MFE is 15%. So we've gotten a good amount of profit, and the price has gone in our position or in our favor quite a bit. And let's try and see how much the price has gone against our position. So this is around $320. So let's look at the 320 range, and here it is. And here's the surprise: the price has gone against us in pretty much the same amount. It's minus 12% and it's plus 15%. So what do you make out of this trade? Let's explore it. TradeOutLoud allows you to do all of this, by the way. You can explore every single trade that you have, right? So here's the trade. So we've entered short over here, and we have closed the position over here, right? So this is the midline, right? So this is the MAE, this is the MFE. Since we're going short, the maximum amount of price that has gone, in our position, in our favor is till here, right? So 30 to 26, and we've pretty much reached that percentage over here, but we've also pretty much reached the same distance in the top, which means we've carried quite a bit of risk. So this is pretty much a 1:1 trade, right? So if I'm being honest, is this a good risk management? Uh, it is okay, right? I mean, nobody could have expected this bar over here, right? Maybe this could have shook me out for a small loss over here, not a big loss, but it could have very easily gone up from here, right? Because this green bar. I mean, we're not going to go into technical analysis, but it's just an example of how we are looking at three different statistics, right? The best exit, your MFE, your MAE, your open price and close price, and combining that and correlating that with your risk management skills, right? And how do you avoid mistakes? Again, this comes back to how we manage tags, right? And you can also use auto insights, which are over here. So for example, if you look at the win rate, and if you, for example, do a volume overlay here, it says that 92% of the trades came from 0 to 500. This is pretty much the full range. Let's look at something that's more useful. So 29% of trades are made in the range $50 to $20 and has a win rate of 75%, right? So a lot of insights you can get from these quick filters, and these insights might help you quickly find what you're good at, what you're bad at, right? And that's exactly what you want. You want to look at small little things that you can improve, and all of those small little things can contribute a large part to your improvement of psychological management or general trading psychology, right? And optimal risk reward is again a really complex and complicated subject, which kind of goes into combining your MFE, MAE, and your exit analysis. Right? Exit analysis is something that's again, highly used feature of TradeSwiss, where we have what could have been the best exit and how much did you actually earn, right? So this tells you things like, are you leaving too much money on the table, right? Are you scared to scale down, right? Are you too greedy, right? Do you have a fear of missing out, so you keep adding to your positions, right? So all of those factors can be explained by these charts, right? So it's as simple as that. For example, you can easily look at let's say the amount of volume that I've traded over here, right? The amount of trades that I've taken over here, right? So again, this is another example of how we are switching back and forth from qualitative to quantitative, and again quantitative to qualitative, right? So again, finally, why would you want to use TradeSwiss for this? Right? There are so many journals, there are so many ways to get quantitative analysis, because TradeSwiss can provide you with so many things other than just simple statistics. And that's the example that we've shown so far in this presentation. Right? Risk management, it's extremely cost effective. We can manage multiple accounts. We've seen advanced charting. We've explored multiple data points and so on. Right? So that's why we suggest using TradeSwiss, because it makes your analysis much simpler. Right? You need to focus on finding insightful data. You need to focus on finding the right path, or identifying the right goal towards which you need to move towards. Right? And that's something TradeSwiss makes it really easy for you. Right? And again, it doesn't matter if you're a beginner trader. It doesn't matter if you're an expert trader. TradeSwiss is something that's super cheap. So TradeSwiss is something that's super feature filled. Right? We've shown you actionable insights. We've shown you real data. We've shown you real insights and real psychological improvements that could be done based on the quantitative analysis that we've done. Right? So that's one of the reasons why people use TradeSwiss not only for journaling the trades. And journaling the trades is just one part of your general trading ecosphere, right? We would say it's a precursor to managing or to improving your trading psychology, or rather in our case it's a requirement, right? You need data to get insights, right? And to get insights you need a platform that can get those insights for you. So these are just the tabs of TradeSwiss where we just saw a lot of different analysis, different ways of looking at data, and so on, right? And the path to consistency, as I've explained it a lot in one of my previous presentations about where we go into the overview of TradeSwiss, is quite simple. Just 10 minutes per day is enough. Right? In this presentation itself, which is around 50 minutes, we've explored around 7-8 different ways of where you can get qualitative improvements, qualitative insights from your quantitative analysis, right? And all it took us was a couple of clicks and a couple of reading a couple of charts. That's it. That's pretty much it. That's all it takes for you to improve your psychology. You don't need to follow 200 books. You don't need to follow so many gurus online. You don't need to follow or take advices from people who you don't know. You can take advice and you can do your own analysis based on your trading data itself. That's a reflection of who you are as a trader. So if you're not looking at that, and if you're looking at other sources of advice, or a shortcut to consistency or success, you are inevitably going to spend a lot of time doing nothing, and you are probably wasting a lot of your time doing that. So final thoughts: breaking down trading psychology is hard, right? So it's something that you would only realize and get an idea of if you have experienced something like greed, fear, FOMO, and things like that when trading, right? And compared to the advice that we get online, you could take a scenario. For example, when you're trading, how do you know when to cut your losses? How do you know when to let your winners run? Right? You only know it's a winner when you close the trade. It could go any way until you close the trade, right? The only objective, ground truth in all of trading is your trading data. Nothing else matters, right? So focusing on your trading data and focusing on the analysis that comes from your trading data can make you a consistently profitable trader, right? This has been proven by so many traders across the world for a very long time. You take any trading book from, let's say, a legendary trader or something like that, they will inevitably talk about trade journaling, right? And that is obviously connected to trading psychology, as we just saw in this presentation, right? Almost all, I wouldn't say almost all, a lot of quantitative analysis can be converted into qualitative analysis, which in turn can help you improve your trading psychology. Right? And this is why TradeSwiss is a truly all-in-one market research and analysis platform which can help you improve your trading both quantitatively and qualitatively. It's not just the P&L that matters, it's also your psychology, it's also your mindset, it's also the way that you want to trade. Right? Trading is not a short-term career. Trading is not something that you learn in a couple of months. Trading is something that you want to keep for your, it's for the rest of your life. It's a skill for life, and you need to treat it that way. Right, so thank you so much for listening to this presentation. And if you are interested in TradeSwiss, you can learn more about it in one of my previous presentations. You can check that video in TimingResearch's YouTube channel. I'll try to link the video down in the description or in the comment section, so you can take a deep dive into how TradeSwiss can help you journal, how TradeSwiss is useful, how TradeSwiss is better, and so on. So this presentation has been purely focused on the analysis part, the quantitative and for qualitative analysis part of TradeSwiss, and how TradeSwiss specifically can help you, right? So, and if you're interested, you can use a 30% discount coupon to get really great discounts on TradeSwiss. You can use the coupon Tech Wizards. So let's do this and let's find our trading edges. Let's improve our trading psychology using proven data driven methods from TradeSwiss.